So the grant, so what is the DCF? We already know the DCF here. What is upcoming? The DCF. Okay. So multiply. What do you have? When you multiply, what do you have?
52.
Figure.
52.
5 what? Just
52.
did you approximate it or what did
Approximated.
what did you have? What did you have? We've not been approximating. What did you have?
51.6. 51.6.
51.6. Okay.
51.7.
So the next cash flow is the net cash flow. The net cash flow means they have taken consideration of what is it called? The cost. They've taken consideration of what? The cost element, the variable cost, the blah 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 like that, right? Don't forget this base case NPV, you are preparing it for the main company, is for the owner of the business. But what you use to discount it is the cost of equity of the on-get company, because it is assumed that company is financed by only by equity, right? No, now this is base case, right? So the next one is the net cash flow. Don't forget the lifespan of the machine is for 3 years, right? And the net cash flow given to us in the question, cash flow, the net cash flow is 260 million, and this 260 million will be for, so now class, hope you know how to use annuity. If we have some, if you don't know how to use annuity formula, please let me know so that I can go back and I can give you the annuity formula in this class. So please use annuity formula from year 1 to 3. What do you have?
2.25.
2.25. Did you approximate?
Yes.
2 decimal place. I just need 2 decimal place. What do you have?
2.25.
2.25. Okay. So don't forget, why I put this grant like this, because it's an inflow. You will receive it. So what do you have when you multiply? Quickly.
585.
5,
85.
5, 8 what?
5.
I can't hear you. 5, 8 what?
585.
Please, someone should confirm this figure, please. Confirm this annuity.
Yeah, it's correct.
Okay. So after that, class, don't forget, when you receive a cash flow, net cash flow, under capital budget, you pay tax. Is that not so? This net cash flow, they say the net cash flow is throughout the lifespan of the machine. That is why we have to do for 3 years. Now, when you have a net cash flow, of course, you will pay tax. And in this question, we were told that tax is being paid in arrears. Tax is being paid in what? In arrears. Is that not so? Now, we now have tax paid. Tax paid, you pay tax on this net cash, on this cash flow, tax paid. So if I want to pay my tax, which year will I start from? Will I start from year 1? The tax is being paid in arrears. Where
You
will I
start
start
from
from?
year 2.
Thank you. Year 2 to year 4, right?
Yes. Yes, sir.
Year one will be paid in year 2. Year 2 will be paid in year 3. Year 3 will be paid in year 4. Okay. So the tax paid, how many percent? 30% of the cash flow tax. 30%. Let me go it out so that you understand. Let me just this. Okay. Tax tax paid. %30%, right? Times 260 million. What do you have? When you multiply it, what do you have?
78.
Class, what do you have?
78.
78. Okay. 78 million. So from year 2 to year 4, you come down and say this is 78 million. So how do we get the DCF? Now, this is where the problem is, right? Now, for you to get the DCF, first, let's calculate annuity. Annuity factor from year 1 to year 4 first. That is the first thing you need to do. So what is the formula equals to, what is the formula for calculating annuity?
1 minus 1 plus R.
Okay. 1 minus
1 plus R.
1 plus R
Raised to power minus N.
All over R.
All over R.
Thank you. I've forgotten. Thanks for the reminder. Divided by R, right? Okay. Divided by R. So, what is the annuity factor from year 1 to sorry. So now 1 minus 1 plus R, the DCF
2.79.
Okay, I'm coming. We need to show it, right? 1 minus 1 plus. The DCF is 0.16. It's 16%, class. 16%. And numbers of years, 4. Divided by 4. So.
Divided by 0.16.
Oh. 0.16, thank you. Since I'm tired though. Let me just complete this part so that we can go. Okay, 0. What?
2.79.
Okay, 2.79.
Approximately 2.8.
2.79. Let's just leave it like that. 2.79. I don't understand. 2.78. Someone say 2.9.
It's 2.7.
We are using 2 decimal place.
Yes, it's 2.798. So if you are using 2 decimal place, it will be 2.80. It's 2.798.
Okay. 2.7 what? 0, right?
2.798. So if you are approximating it to 2 decimal points, that 8 now will add to that 9, so it will become 2.8.
Okay, something.
No, 2 decimal place is 2.79, no guy.
And now, but when you are
2.8.
You use 2.8 now.
Sir, please, it's 2.79.
It's 2.8. If you are approximating 2.7 to 1 decimal place, it becomes 2.8.
There's no approximation when you are using 2 decimal place, so you don't have to approximate. You stop at the 2 figures behind the point. So you're going to use 2.79 instead of 2.7 instead of 2.8. We are using 2 decimal places, so any other number behind the 79 is not useful to us. So we'll stop at 2.79.
I don't agree with that, Sha, but let's go on.
Okay. Interesting. Okay. Mathematics, we agree and disagree, but I'll clarify that. Now, if this is 2.79, what we are looking for is the DCF from where? From we need DCF from 2 to 4. Now, another thing you need to do, this is for year 1 to 4 class. Another thing you need DCF from year 1 to 3. You know what you need, the DCF you need is from year, you need to remove year 1. Sorry about that. You need to remove year.
So I
Wait
think we need to
now.
remove 1 to.
Hello, wait. I'm still talking, please. Wait. Now, you have from year 1 to year 4. Is that not so? You have 2.79. And you need 2 to 4. Now, if you need 2 to 4 from this part, you just need to remove year 1. So when you remove year 1, you are left with 2 to 4. Right? So in this case, you can have the DCF. The DCF, the way we normally calculate the DCF, right? So let me just copy this. What is the DCF? What is the formula? So equals to 1 divided by 1
1 plus
plus
rest of
R,
minus.
right? Or minus anyone that you want to use. This one is N, right? So me, I'm using this formula. So in this case, right? So what do we have? If we have this, what is the DCF for year 1? Just for year 1, we've calculated it before now. This is it. Is that also 0.86? That is the DCF for year 1, right? So we can say equals to 0.86, which will be for year 1 class. So for you to get for year 4, for you to get from year 2 to 4, you have to remove year 1. When you remove year 1 from 2.79, you have 2 to 4. So you remove this.
1.93.
Right? So when you remove it, you can have year 2 to year 4. So 2.79 minus 0.86, what do you have?
1.93.
What do you have?
1.93.
1.93. Right? 1.93. And that is the DCF from 2 to 4 class. Whichever way they give you. If you are looking for 9 to 10 class, if you are looking for 9 to 10, do from year 1 to 10. Right? Then you remove from year 1 to 8. Remove it. When you remove year 1 to 8, you have 9 to 10. Class, are we still together? So this is 1.993. 1.93. 1.93. So what do you have here?
150.54.
150.5.
150.
Okay. 150.
No,
So this will be
150.54. 150.54.
0.54.
Yeah.
Okay. 0.5. We use 1, okay. 0.54, right? We're supposed to, in this place, we use 51.7. Okay. let's just leave it like this, right? So this will be outflow, but you have to be consistent with whichever decimal you are using, right? You have to be You have to be consistent. So the next you need to calculate is the tax savings. Don't forget that in the question, we're told that the capital allowance is allowed. The depreciation is allowed for tax purpose, right? Now, class, let's quickly go back and check. Finally, before we go, the tax rate is 30%. The straight line depreciation on the costs, net cost of the machine after deduction of what? The grant is tax allowable, which means that the cost of the asset is 600 minus the grant, then you cannot allow it for tax. It is depreciation, but it is allowed for tax. So, which means that depreciation is still the same thing as capital allowance. Is that not so? So, you need to do a tax savings on the capital allowance. Class, do we get that? Hello, class.
I did not get that, sir.
Who is that? Who is
Moses?
Okay. You did not understand this part. Okay.
Yes.
Now, straight line depreciation on the net cost of the machine. Depreciation is not allowed. The cost of the machine is 600, and they say after deduction of it is net. You remove grant, right? It's on straight line method. What is straight line method? Cost divided by the numbers of years. Cost minus residual value divided by the numbers of years will give you the depreciation. And we were told that this depreciation is allowed, which means that depreciation is still capital allowance because it is tax allowable. Therefore, you need to do a tax savings on it. So that is, do you get that? So you can check. Do you understand?
Yes, sir.
Yes, sir.
So the machine cost, for us to get that, so the machine cost is equals to 600 million. You remove the grant to get the net, right? Net, what is the grant? The grant is 60 million. The grant is 60 million. So the net cost that they say you should charge depreciation on, this is the net cost of the machine. Net cost. Class. So what is the difference? That is 540, right?
Yes.
540, yeah.
Thank you. So this is 540, right? So this is the net. So on this 540, that is where you will now charge your what? Your depreciation, because they say net. It is the what? Net. So we can now say depreciation. We can now calculate our depreciation, and that depreciation is tax allowable as that. Aisha.
All right, sir. I don't really understand this part. I don't know why we are letting the grant from the cost, since the total cost is 600 million, and we ought to charge depreciation on the cost. So I don't understand.
Sincerely, I'm tired. Aisha, see it here now. See it here. After deduction of the grants, before you can charge.
Okay, I'm sorry. I think I've gotten myself back. I saw net cost. Now I think that's why. I'm sorry.
It's fine. Net cost. So the depreciation is actually allowed. That is the capital allowance. So the depreciation depreciation is equals to the cost, the net cost, 540 million divided by the numbers of years. What do you have, class?
180
180
million.
180 million. And this 180 million is allowed for tax purpose. This 180 million is like your capital allowance. Don't forget, capital allowance, you have to do your tax savings on it. Is that not so? Just like the way we did in cost of capital. So tax savings, because it is allowed, our tax is 30% times the 180. What do you have?
54 million.
Okay. So the tax savings will still be paid from year 2 to year 4. Because tax is being paid in what? In arrears. Tax savings. Then for those who, I think the issue here is 2 decimal, 3 decimal, 2 decimal, 3 decimal. Please, whichever decimal that you prefer, that you understand, use it. If it is all the figure, if you like, you can decide that you want to write all the figures there when you do your DCF, write it, and you move on. See, see, anything that will confuse you, avoid it. anything that will confuse you, figures, add, subtract, put, even if it is this million, I put, I wrote million up, right? See, if that one will confuse you, write it in full, I beg, and see, write it in full, I just move on. So, anyone you feel, I beg. So, the tax saving here, right? So, what do you have? When you multiply, what do you have?
104, 220.
104 points. 104. Do we have point what?
22.
0.22. Okay. Oh. Now, no any other cash flow, right? No any other cash flow. Right, class? Tax savings. So, what will be the base case NPV? Case NPV. So, in our next class, we will calculate the financing PV or financing effects. Class, what is the base case NPV here? Is it positive or negative?
Negative.
What is the negative figure?
I have 9,595,000.
9 million, okay.
I'm using the full thing.
I'm not using full. Give me those people who give me this in a bed. Let me leave.
9.62. It's 9 million.
9.62.
62.
9.62. Okay, 9.62.
Negative.
9.62. Right? 9.6 negative. So, any question? So 9.62, right? So you can use 3 decimal. You can use 3 decimal. You can use 2 decimal. Please use the one that you understand. If it is 2 decimal, use 2. If it is 1 decimal, use 1, and move on with it, right? What is most important is your presentation and what you are doing, right? So, and I think we are done with this part. Please, if you have your question, You can unmute your mic. Don't forget, at the beginning of this class, in summary, at the beginning of this class, we talk about adjusted present value. It comprises of all cash, all sources of finance. And for you to determine adjusted present value, you need two items, just two items. And what are these items? The base case NPV and the PV of financing effects. We give you adjusted present value. Then, when you are to determine the base case NPV, assume that the business will be financed by equity. And if the business is being financed by equity, what will you use to discount? It is the ungeared cost of equity, right? And your base case NPV is your normal capital budget, capital investment, your cash inflow, your cash outflow. The only difference is that when you do year 2 to 4, 5 to 6, 6 to 9, and that is the only difference between them. But they are still the same thing. And I said that when the steps in calculating this, there are two steps. Either you use the Modigliani and Miller assumption of preposition 2, or you go back under the risk adjusted cost of capital. You say identify the policy company, calculate this asset beta. If asset beta is given to you in the question, you don't need to calculate it again. Just go ahead and insert it here, right? Go ahead and insert it here and get your cost of equity of the ungeared company class. Now, when you get it, or if the equity beta of the quasi company is not given to you, of course, what is the formula? Which formula has equity beta? It's CAPM. And that is why we have to come back to this part. Where is it? Right? That is why we have to go through this route. Because if the cost of equity is given to you, the risk-free is given to you, the premium is given to you. So you can get equity beta. In that equity beta, you can use it to determine your asset beta, which is this. When you determine your asset beta, you calculate your cost of equity of the ungeared company using the asset beta, because we skip step 4. We don't need it because it is assumed that your asset beta is equals to your equity beta. Now, or you say, oh, since Modigliani and Miller understand this formula and move on. Check in the question. Is the cost of equity of that quasi company, is it given to you in the question? Which means that everything here will be equals to this, right? We are looking for this, the cost of debt, right? The cost of debt of the quasi company. If it is not given, use the commercial rate given to you in the question. The commercial rate is the total rate that everybody is using. What GT is using is what Fidelity Bank is using, whether you are diversifying or not, right? Now, and I said that, please take note of that. Then we use it to determine the cost of equity of the ungeared company, which will arrive at the same answer. We proceed to calculate the base case NPV using the relevant cash flow. From our question, the machine is 600. The grant is being received at the end of year 2, right? If a grant is being received at the end of at the beginning of year 2, which means that it would have occurred at the end of year 1, right? At the end of year 1, and that is why we say grant. You put grant first, right? Then there's a net cash flow before what? There's a net cash flow, right? That is yet to take effect of tax. We bring it. The machine life is for 3 years. Then we now said, oh, if that will be the case, what will be the DCF? We use annuity to get that. We have the inflow. Of course, when you have the net cash inflow, you pay tax on that. And that is why we say tax. Then according to the question says that tax is being paid in arrears. So which means year 1 will be paid in year 2, year 2 will be paid in year 3, year 3 will be paid in year 4, right? And that is why we have 2 to 4. Now we proceed to say the tax savings on tax savings. Why do we have to have tax savings? We were told that the tax savings, the depreciation on a straight line method is tax allowable, right? After what? The net of the cost of the machine. That is why we say the cost of the machine minus the grant, that we have the net cost of the machine, right? The straight line method is calculated as the cost minus residual value. The residual value is not given to us in this question, divided by the numbers of years, right? So the cost of the assets divided by the numbers of years, you have the depreciation, right? And the depreciation is allowed for tax. So which means that depreciation is capital allowance. That's why we charge tax savings, and it is still the same thing as what the tax savings of 2 to what? 2 to 4, right? And that is why we have been able to arrive at the best case what? NPV. In our next class, we look at the PV of financing. Then we will now match the two. Then we'll decide, is this viable or not, right? And I also have about 4 questions, examinable questions on adjusted what?